Hello everybody, today we're going to be doing an update here on McDonald's MCD ticker symbol. And it's everybody's favorite fast food. Just kidding. I mean, the kids really love it. It's their favorite fast food. I don't really like McDonald's. I prefer to cook my own hamburgers, honestly. But anyways, we're going to be looking at their numbers here. So as you can see from 2014, the free cash flow was 4 billion, and then now in 2023 it's 7 billion. As you can see here from 2020 upwards, there's been a big difference in the annual free cash flow for McDonald's, which makes a lot of sense because their business model has changed. I would suggest you look into it. Basically, they have a lot of real estate, and the franchises, it costs them a lot less money to run now, and the way they split the revenues and stuff. I suggest just look into it, do a deep dive on it and look how that happens for McDonald's. We're not going to spend much time on it. We will come over here and take a look at their revenue. This is that part of what I was just saying is why the revenue doesn't increase much over the last 10 years. You can see 2014 were lower in 2023 and all these other years. But the way that their net income works, you come down here to their net income, as you can see, there's a difference here. It's doubled from 2014 to 2023. So that's why I suggest you look into it. The net income's great for McDonald's. As you can see, the last 12 months it was up 37%. That's fucking ridiculous. Their shares outstanding, they decline a little bit, not much. We're down as of December 31st, 2023 to 732. Doesn't decrease by much, but nonetheless it's still decreasing. And you come to their assets and liabilities. Their assets increased by 11%, but their long-term debt increased by 3%. Their total liabilities also increased by 7.82%. So technically they have more liabilities than total assets. Something to keep in mind when you're looking into a company like McDonald's. Their margins are really good. You can see their profit margin as of December was 33%, really good. You can look into their latest earnings report. If you come here to McDonald's, analysts say it's a moderate buy at 2.71, 16% upside when you compare today's price to the average price target by analysts. We'll go ahead and make our own assumptions. There is seller insiding, as you can see. The short interest is healthy. The projected earning growth is 8.29% for earnings per share, as you can see, from 12.18 to 13.19 per share for the expectations projections. Their dividend 2.44% yield, annual dividend is 6.68, dividend increase track record 48 years. Their dividend payments pretty healthy at 56%. Their 3-year dividend growth rate is 7.32%. As you can see, though, McDonald's is willing to take a loss on these $5 meal deals that they've been talking about because, the economy is struggling and everyone is just fucking fed up with the ridiculous increases. They even do talk about it in this article, how since 2014 we've seen 100% in menu prices, which is absolutely insane. I don't really find myself eating fast food. I just started losing weight because of how expensive it is. So thank you, fast food companies, for allowing a lot of us to stop, taking the easy way out and cooking for ourselves. So let's get into the real nitty gritty. We're going to use their free cash flow from 2014 to 2023 with a 10% growth rate because of the free cash flow growing. We're going to be going upon that. And we're going to use an 8% discount rate with 726 shares outstanding. And then we have $227.16 for McDonald's. If you come to their dividend discount model, I don't know why it says KO. Sorry. MCD 6.68, 8% growth rate, 10% discount rate. We come to $360.72. We'll go ahead and change this to MCD. As you can see, that's a huge change in the price. But then again, we just saw it was at 7.32% for the last 3 years. So let's go ahead and lower this to 7%. So that goes ahead and brings us down to $238.25. Now, if you want to use a discount rate of 8.5%, so kind of similar to 8% I was using for the DCS for a company like McDonald's since they go for a premium, This will bring us to $476.51. But for dividend discount models, most of the time, depending upon the company, a company like McDonald's with high growth rates, I'll go ahead and use a 10% discount rate to give myself a margin of safety. But I do think that they are going to increase it fairly well with all this cash flow. So I like the 8%, but we'll just go ahead and keep it at the 7% and the $238.25. The Benjamin Graham, we got a 12 EPS, so we're going under the 12.18. We're going to use a 10% growth rate, for corporate bond rate, PE of 20 for McDonald's, comes us to $265.32. So you can see here in the dividend discount model, I did leave it at the 360, so it was the 8% growth rate. But let's go ahead and just do it exactly the way that it is right now. Instead of the 8% that I'm projecting for my projections, to give that margin of safety and show that margin of safety. And we go ahead and go $267. So we come to a value of $253. The current price is at $273.51 with a 10% discount rate upon this at $225. My buy range, as you can see here, my target buy range is $250. I would like to play some premium just to have a little bit of McDonald's in my portfolio, you know, because I do like to show the kids, hey, you buy these kind of products, maybe you should own the company, you know. I like to show that to the kids. So will I have a huge position in it? Absolutely not. I'm just going to buy a couple shares, you know, less than 1% of my portfolio just to own it. But if I was going to be buying this heavily, I'd like to give myself a margin of safety. I would probably start buying a real position and put it into my long-term portfolio at $220. Let me know what you think about McDonald's. Do you guys think you would like to own it? I'm not too sure that it would outperform the SPY over the next 10 years or the QQQ or a lot of growth companies that you may have got at great valuations during the last few years. So for that, for me, it's more just a teaching lesson for my kids, not a company I'm excited to grab anytime soon. Thank you.